Ever wondered if a fund truly beat the market, or just got lucky riding it? Jensen's Alpha answers that. It measures a fund's actual return versus the return it should have achieved based on its market risk, helping you see if the manager really added value. Before we dive in, a quick note. This video is for educational purposes only. Always consult a financial advisor before investing. Let's start with a simple question. That impressive return your fund posted, was it real skill, or just the market doing well? Jensen's Alpha helps you find out. In simple terms, Jensen's Alpha tells you how much extra return a fund generated after adjusting for market risk. A positive alpha means skill. A negative one means underperformance. And remember, pair it with the Sharpe and Trainer ratios for a complete analysis. It uses the capital asset pricing model, commonly known as CAPM, which predicts how much a fund should return based on its exposure to the market. Then it compares that with what the fund actually delivered. The difference? That's the alpha, the manager's real contribution. Here's the formula. Jensen's Alpha equals the portfolio return minus the return predicted by CAPM. Each part plays a role. Rp is your portfolio return, Rf is the risk-free rate, Rm is the market's return, and beta shows how sensitive the fund is to the market. Step 1. Calculate the expected return using CAPM, the risk-free rate plus beta times the market premium. That gives you the return justified purely by market risk. Step 2. Subtract that CAPM expected return from your fund's actual return. If the result is positive, you've got true outperformance. Let's understand the calculation with an example. A fund earns 14%, the risk-free rate is 5%, market returns 11%, and beta is 1.1. Expected return is equal to 5% plus 1.1 times 11 minus 5 is equal to 11.6%. The actual return minus expected gives an alpha of 2.4%, solid outperformance. A positive alpha means the manager added value beyond market trends. 0 means returns matched market expectations. Negative? That's underperformance after accounting for risk. Jensen's Alpha helps you tell the difference between true skill and plain market movement. It's an essential metric when judging active fund managers. Here's how Jensen's Alpha differs from other metrics. Sharpe adjusts for total volatility, Trainer focuses on market risk, and Jensen looks at pure outperformance versus CAPM predictions. Each gives a unique perspective. Remember, no metric is perfect. Jensen's Alpha relies on capital asset pricing model, which assumes rational markets, not always true. It ignores company-specific risks and is purely backward-looking. When using Jensen's Alpha, check for consistent positive values over time. Compare apples to apples, same benchmarks, same periods, and combine it with Sharpe, Trainer, and the expense ratio before making a call. In India, beta is usually benchmarked against the Nifty 50 or Sensex. That makes Jensen's Alpha a reliable way to gauge active manager skill in equity funds. In short, Jensen's Alpha measures skill-adjusted performance. If it's positive, your manager added value, but check for consistency and context before deciding. Thanks for watching. Check out the description for extra resources and related videos. And if you found this video helpful, give it a thumbs up and share it with someone who's trying to make smarter investment decisions. And don't forget to subscribe to Secure My Wish, where we simplify finance, one concept at a time.